studying your last two. I swim med when tunden. Det styren down to mute. And can learn the pole that sunk he died.
In this slide, we'll introduce one of the most important concepts in Canadian corporate taxation, the General Rate Income Pool, commonly known as GRIP. At first, the name may sound complicated, but the idea is actually quite simple. Think of GRIP as the corporation's eligible dividend wallet. It's important to understand that GRIP is not cash. It is not a bank account, and it does not appear on the corporation's financial statements. Instead, GRIP is a special tax account maintained for income tax purposes. Its only job is to track how much eligible dividend a corporation is allowed to pay to its shareholders. So, how is GRIP created? Whenever a corporation earns active business income that is taxed at the general corporate tax rate, that income generally increases the corporation's GRIP balance. In other words, profits that have already been taxed at the higher general corporate tax rate build up the corporation's capacity to pay eligible dividends in the future. But what is GRIP actually used for? The answer is simple. GRIP allows a corporation to designate dividends as eligible dividends when they are paid to shareholders. Eligible dividends receive more favorable personal tax treatment than non-eligible dividends, helping achieve better integration between corporate tax and personal tax. One of the easiest ways to understand GRIP is to compare it with cash. Cash is real money sitting in the corporation's bank account. It can be used to pay salaries, suppliers, rent, or other business expenses. GRIP, on the other hand, is only a tax record. It cannot be spent, transferred, or withdrawn. It simply tracks the corporation's eligible dividend capacity. That's why the wallet illustration is so helpful. Imagine that every time the corporation earns qualifying general rate income, a few coins are added to its GRIP wallet. Those coins don't represent actual dollars, they represent the corporation's ability to pay eligible dividends. The key takeaway is this: GRIP is a tax account, not a cash account. Its purpose is to measure how much eligible dividend the corporation can legally designate when distributing profits to its shareholders. Thinking of GRIP as the corporation's eligible dividend wallet is one of the easiest ways to remember this concept. Now that we understand what GRIP is, let's see how the GRIP balance changes over time. Think of GRIP as a special wallet that keeps track of the corporation's ability to pay eligible dividends. Just like a bank account has deposits and withdrawals, the GRIP balance also increases and decreases as different corporate events occur. Let's start with what increases the GRIP balance. When a corporation earns active business income that is taxed at the general corporate tax rate, that income generally increases its GRIP balance. In simple terms, every time the corporation earns qualifying general rate income, more capacity is added to its eligible dividend wallet. Now let's look at what decreases the GRIP balance. Whenever the corporation declares and pays eligible dividends to its shareholders, part of its GRIP balance is used. You can imagine coins leaving the wallet because the corporation is using its available eligible dividend capacity. The example at the bottom illustrates this process. Suppose the corporation begins the year with an opening GRIP balance of $80,000. During the year, it earns $40,000 of additional general rate income. This increases the GRIP balance to $120,000. Later, the corporation pays $50,000 of eligible dividends to its shareholders. Since eligible dividends reduce the available GRIP balance, the corporation finishes the year with a closing GRIP balance of $70,000. The warning box highlights another important rule. If a corporation has no GRIP balance, it generally cannot designate dividends as eligible dividends. Instead, it may only be able to pay non-eligible dividends. which are taxed differently in the hands of shareholders. This is why maintaining an accurate GRIP balance is so important. Every year, corporations use Schedule 53 to calculate the opening balance, add any eligible increases, subtract eligible dividends paid, and determine the closing GRIP balance that will carry forward to the next tax year. The key takeaway is easy to remember. GRIP increases when the corporation earns qualifying general rate income, and GRIP decreases when eligible dividends are paid. Think of it exactly like a wallet money, or in this case dividend capacity, goes in and comes out over time, and Schedule 53 keeps track of the remaining balance. In this final slide, let's see why Schedule 53 is so important in the overall T2 corporate tax return. The process begins when a corporation earns active business income that is taxed at the general corporate tax rate. This type of income increases the corporation's general rate income pool, or GRIP, and Schedule 53 is used to calculate and maintain that balance. Once the GRIP balance has been determined, the corporation knows how much of its future dividends can be designated as eligible dividends. When those eligible dividends are declared and paid to shareholders, they are reported on Schedule 3. This shows how Schedule 53 and Schedule 3 work together. Schedule 53 determines the corporation's eligible dividend capacity, while Schedule 3 reports the actual dividends that were paid during the year. One schedule calculates the corporation's ability to pay eligible dividends, and the other records that the dividends were actually paid. Maintaining an accurate GRIP balance provides several important benefits. It allows shareholders to receive eligible dividends that generally receive more favorable personal tax treatment. It also supports proper tax integration between the corporation and its shareholders, helps ensure CRA compliance, and allows the corporation to correctly designate dividends as eligible or non-eligible. The flowchart on the right summarizes the complete process. The corporation earns general rate income. Schedule 53 calculates the GRIP balance. That balance determines how much eligible dividend the corporation can designate. The corporation then declares eligible dividends, and those dividends are reported on Schedule 3. It's also important to avoid some common mistakes. A corporation should never designate eligible dividends without first confirming that it has a sufficient GRIP balance. Other common errors include forgetting to update Schedule 53 each year, using an incorrect opening GRIP balance, misclassifying eligible and non-eligible dividends, or overlooking the impact that dividend designations can have on the corporation's T2 tax return. The most important concept to remember is this: Schedule 53 acts as the corporation's eligibility checker for dividends. Before declaring an eligible dividend, the corporation should always confirm that its GRIP balance is sufficient. In simple terms, Schedule 53 tells you whether your corporation has enough GRIP to pay eligible dividends.